Good evening and welcome to all of you in today's webinar on crypto assets, India and global tax landscape. Today, we have the distinguished presence of CA Sanjay Agarwal sir, who is the chairman of Direct Taxes Committee. Also, we have CA Piyush Chatter sir, vice chairman of Direct Tax Committee, and CA Rishabh Agarwal sir, who is also the moderator for today's webinar and having expertise in the field of direct taxes, international taxation, transfer pricing, and FEMA. And he has also earned his master's in law degree in international taxation from the prestigious Vienna University of Economics and Business. Along with this, the speaker for today's webinar international tax and transfer pricing and an interdisciplinary researcher. She has also worked with various consulting firms and in-house roles. She has contributed to several research papers, articles, and book chapters on a wide range of topics. She has multiple degree, diplomas, and certifications in subjects relating to tax, valuation, legal, and other fields. With this, I request C. Sanjay Agarwal sir to kindly give the opening remarks for this webinar. Over to you, sir.
Thank you. Thank you, Prachi. Thanks a lot for giving the introduction of the speaker, moderator, everyone. Namaskar and good evening to Indian viewers and good morning, good afternoon to the viewers at overseas. Like Prachi, this Jalan, Nupur Jalan, she is in the middle of the afternoon addressing for me. So I welcome all of you in this webinar today on India and global landscape on crypto assets. I also welcome Rishabh Agarwal, my son also, CA Rishabh Agarwal, and Prachi Jalan, Nupur Jalan. I met her first time in the IFA, and then I was quite impressed, and thereafter I was behind her that you need to address one of the topic which you have taken in the IFA, and this was very close to my heart. That is why I requested her to be there so we could get the time from her to address us and explain various nuances of the crypto assets and cryptocurrencies. You see, the crypto assets, which includes Bitcoin, Ethernet, and digital assets, having gained significant popularity globally in this, you can say, about the cryptocurrencies. Friends, I attended one of the IFS conference also beside IFA, where the cryptos various aspects have been discussed. In IFS, there was a discussion which was basically on accountant side. That particular conference was there, wherein at Word we were discussing that whether it is in an asset or it is in a bank, it is an investment or it is nothing. Then how to measure it, how to see it, whether the capital gain will come, business profit will come, or any other type of income will come. How the taxation will happen, which country will have what taxation, whether it will have any CITES problem, etc. So all these things were discussed in various forums. And for this, I think we have the best of best brain now available with us. So not taking much of your time on the topic itself, I would request my vice chairman to say a few words, and then it is over to Rishabh to take forward for the balance of the topic. I will be taking little excuse in between and coming back late in the evening. Thank you very much, viewers. I know you have joined in large number today, and the recording will also be available thereafter. So those who are in mid of night overseas, if they want, they can get the later on the DLH portal the recording of this webinar also. The disclaimer from the issued side, which we always make, I would like to make here that the views are the views of the speakers or the moderators. The views of the issues may be different and they are not binding on the ICI. So this disclaimer I always make. With this, thank you very much. And Piyush Bhai, please take the further proceedings.
Thank you very much, Chairman Sir, Sanjay Agarwal ji, the faculty for the day, Nupur Jalan, moderator, Shri Rishabh Agarwal, other teams, all the participants, a warm welcome this evening. Indeed, it's a very great subject which has been selected, and the speaker like Nupur, of whom I was just listening from Chairman, she being an expert, I'm sure the participants will be immensely benefit. And the Rishabh himself is an authority on the international tax perspective itself. And I'm sure when it comes to crypto, which is largely not yet settled, not yet explored also, I would say, and it is evolving. And a lot of issues are being discussed, whether the crypto trading from an Indian perspective, Nupur, would be really legal to do, or taxation is another aspect. But a lot of questions are being raised on legality as far as Indian people are concerned. And I'm sure if you will be able to address on that, I think so participants would be largely benefit. With the permission of my chairman, just a small update. I think so. Just now with the all the hard work of our chairman, sir, Income Tax Department has approved to have a tax clinic jointly with the Institute of Chartered Accountants. And this would be creating a tax awareness on 13th and 14th of July, all over 164 branches. So I would look forward all the members, all the participants, wherever they are located, their local branches would be conducting. And if they can also participate, or they can guide the general people that they should attend, who are not even a tax assessee, they should guide them, whomsoever they are in touch, maybe in their offices, maybe their staff in their offices. And if they want to have a PAN, they want some guidance on this, they can guide them to our institute offices on 13th, 14th July when this will be coming up. So I thought I will just update on that with permission of my chairman. And this fortnightly seminars are been going on. DTC is trying to do this online webinar where we get a very good amount of participants. Even the next seminar is again scheduled on 5th of July when direct tax expert Rajan Vora would be speaking on the very important topic. So I would look forward that all the participants will enjoy this seminars and keep on looking forward to this type of webinars and be participative. So thank you very much and I welcome you all. And I have a happy learning from Nupur Jalan especially. Thank you. Thank you very much. Rishabh, you may take it forward from here. Thank you.
Thank you, Piyush sir. Thank you, Piyush sir and Sanjay sir for a wonderful welcome address. I think there were certain network issues while the introduction of our today's speaker. So I'll take the privilege to introduce her again little bit to our audience. Her introduction profile was pretty long, so just a couple of highlights from that. So she's been working continuously in corporate tax, international tax, and transfer pricing, and definitely, I mean, if you go up on her LinkedIn, you will see how inclined she is towards the research field as well. So, and I think the recent interests are in the bigger domain of tax and technology. So hence, she's the go-to person for us to come on speak on crypto taxation. And I applaud her allegiance to ICI as a chartered accountant. Like she's streaming live from Germany, where she stays and where she works, and in the middle of the day on a working day, giving her time to disseminate her knowledge on today's subject. And I think she'll be taking us towards a lot of aspects on how these tokens, or let's say digital assets, are being classified in different categories, or what heads of income, not just in India, across the globe, and on how these tokens or these currencies came into existence, and what are the use case scenarios. And I think we'll keep on taking questions in the middle as and when she's comfortable. And just one update that we have close to 700 participants already. who are joined with us on this interesting topic. So without a further ado, Nopur, on to you to take ahead these proceedings on today's topic.
Yeah. Thank you. Thanks all for introduction. And thanks for inviting me for the session. I'll just share my screen. Just give me a second. Is my screen visible?
Yeah.
So the topic for today is crypto asset. So what is crypto asset? So the entire concept of crypto asset came through the blockchain technology. I would expect that most of the people present today or hearing today would have heard about the word blockchain. And crypto asset is again entail different sort of assets that are blockchain based. It's just not cryptocurrency. So what is blockchain? Blockchain is a database of ledger spread over computer in blockchain network and is not managed by any central authority. That means it is mainly decentralized. Now, coming to cryptocurrency, which is one limb of crypto asset. Like I said, crypto asset can be of different type. So the use cases of crypto asset is increasing day by day across the globe. And even there are different variant of cryptocurrencies that has emerged over the period of time. So how cryptocurrency actually works, that is what is reflected in this slide. So let's take an example that A wants to transfer money to B, or let's say A wants to transfer cryptocurrency to B. How this will be processed? A will initiate the transaction. The transaction will then be broadcasted on peer-to-peer network. The transaction will then be validated via some consensus mechanism. There are different sort of consensus mechanism, proof of work, proof of stake. I'll come to those a bit later. Then the transaction will be validated. Once the transaction is validated, the transaction will be added to the blockchain network in the form of block. The transaction then will be verified, and then the money, the cryptocurrency will be transferred from A's wallet to B. Now, coming to different form of consensus mechanism, I'm just covering here crypto mining and crypto staking because those are the prominent one. Proof of work mainly entails solving complex mathematical puzzle, like here it is written, mining capability, and depends on computational power. The mining capability depends upon the computation power of the miner, and the first miner to solve the complex puzzle is the one who gets rewarded with the mining token. What is proof of stake? So proof of work was, and a lot of energy was required for proof of work. So eventually there was a lot of discussion in the community that what could be the different consensus mechanism that can be used. And eventually proof of stake came along with, through the Ethereum network, and Ethereum launched proof of stake. And in proof of stake, what happened? It is not that miners have to solve complex puzzle. Rather, what people do is they stake they put their stake in the network, and whosoever puts the highest stake has more chances to get a chance of validating the transaction. And the reward also here is more in the form of transaction fee, commission fee, vis-a-vis block reward always. Now, coming to this slide, the diagram here shows some of the critical events that have occurred in the crypto space over the period of time. I'll not run through all of those. In 2008 and 2009, it all started with Bitcoin white paper, which we all know that the entire talk about the crypto space started happening with the Bitcoin, and Bitcoin was the first cryptocurrency that happened. And now we see a whole lot of other cryptocurrency. And then in 2012-13, proof of stake came along as an alternative consensus mechanism, like I discussed in the previous slide. Then 2015-16, Ethereum introduced programmable blockchain. So Ethereum has a currency known as Ether, but Ethereum also provides decentralized app where we can build different like we can code smart contract like Solidity programming language or multiple other sort of things. Then I'm not going through all this, will be available for review in the slide, but later into 2020-21, some countries started recognizing it as a legal tender. And the major pick in this segment occurred in 2021 time, where we see that the market cap surpassed $2 trillion. And then in 2022, more countries started recognizing it as legal tender. Central African country, Panama, market cap went on going. But yes, there is bit light phase in crypto space now. It's not same, but still, considering the number of use cases that are developing in entire crypto asset community or around the blockchain community, like DeFi, DAOs, or multiple other things, the segment may grow, will come back to its normal form, considering the use cases. Below you see that I have also listed some of the types of cryptocurrencies. Like these are just some examples: Bitcoin, Dogecoin, Cardano, Ether, Polkadot. Now coming to next slide. The purpose of this slide is to show why cryptocurrency is becoming relevant. This is data from 2022. This is not the latest data, but still, if you see that many public companies also have such large amount of cryptocurrencies recorded in their balance sheet. That means people do, even companies are now getting into this direction and seeing how they can use different variants of crypto asset or cryptocurrencies per se. And some of the use case I listed down below, like it could be Ripple is a global exchange platform. Like I said, Ethereum provides platform solidity for coding of smart contract. There are different sort of stable coins that are going forward in the market. Now we'll discuss stable coin later. This screenshot, this image I took today from CoinMarketCap. This shows, like I just could pick some top ones from the top. This just shows that what is the market capitalization going around in the industry. And this all are crypto assets, not all are cryptocurrencies, like I said earlier. But still, this reflects that why the segment is becoming more and more important, considering the market cap that is going around in the industry. And again, I listed some of other use cases for reading purposes, for later, different decentralized app DeFi networks, which network can be used for what purpose, or which crypto asset are used for which purposes. Now coming to our main question for the day, that is around the taxation. So why is it so difficult to have clear rules for taxation purpose for virtual currency? First, I'm going to virtual currency and not discussing about crypto asset in total. So let's think of cryptocurrency, or let's take example of cryptocurrency. There is no unified definition of cryptocurrencies around the globe. That is the biggest problem. And then even in cryptocurrency, the token, the way the token are evolving, each token or different token may have different characteristics. So even it is difficult for policymakers to have uniform definition. And that's why it is written here that for classification purpose, one has to actually look at the economic purpose, the risk, the rights and liability associated with the asset, and the way the asset derives its value. Now, the right side of the slide shows how classification varies across the countries. Some treat it as intangible asset, some treat as financial instrument. Like Sanjeev sir was saying earlier also that he attended the IFS and he was having similar discussion that it is recognized differently and there were discussion about the classification issues. Some recognize it as commodity. Some, like I said earlier, some countries granted status of legal tender. And this slide shows that was on classification. Now, if we see fourth row of this table, you see the preferred terminology. I am using now cryptocurrency. Some country use broad term virtual currency. Like in India, we use virtual digital asset. Some says virtual currency, digital token. So the way it is used as a terminology is also defined differently in different countries. And then comes along the designation, which we already spoke about in the previous slide. And this slide is reiterating that different countries are having different classification mechanism for this. This slide also discusses some parts on VAT and how VAT is applicable on that country, but I'm not going much into indirect tax today. But this gives an idea that even the VAT regime is not same across the globe. Some do levy VAT on such transactions. Some countries say, like in Europe, which I'll discuss later, there was a judgment where it was said that cryptocurrency, specifically cryptocurrency, should be treated as medium of exchange, or it should be treated as a synonym for medium of exchange. So there should be no VAT on cryptocurrency transaction. Coming to next slide, we have now discussed about classification, nomenclature, or terminology. Now coming to taxable event. So this slide is just represents some taxable event, not all the taxable event. You can see that in next slide. Again, the taxable event for similar transaction could vary across country. Like say mining transactions, some countries say that mining rewards are taxed at the time when mining token is given to the miner. Some says no, we will defer it to the disposal event, like India does that. India, as per Indian law, it is deferred till the disposal stage. Even a different, so similarly, different countries have different approaches for handling different sort of transaction. That was just on mining transaction, but there could be multiple transaction in multiple taxable event that can be generated in crypto currencies, which I'll show in next slide. And I discussed previously here about payment token, utility token, security token. So just in this slide, a description of the same is given. Mainly, each token have different underlying characteristic, like payment token. Payment token is usually used for the payment purpose or as a store of value. Security is used for investment purpose, or they are usually security token are held for investment purposes. Utility token are used mainly for facilitate exchange of goods and services, or for or have some underlying capability of buying some goods or services. Like that also I can discuss later in the case of NFT also, where there are some NFTs which have characteristics which can be exchanged with physical goods. Now I spoke about mining reward in previous slide here. This slide is, I hope it is visible a bit. This shows different sort of transaction that can happen in a cryptocurrency lifespan. And again, here there are only 25 crypto asset listed, not all are cryptocurrencies. And different crypto asset can have different taxable event. Like it is ticked here that which taxable event could happen in a particular crypto asset. And like the laws in which the countries have defined their laws, they have never clarified around all the stages, all sort of transaction that is happening in the crypto life cycle. I mean, the taxation around all the potential transactions. So in Indian law also, it is very broadly defined, and there are like ICO, initial coin offering, or multiple other things are not clarified still in Indian laws. So people have to just interpret and figure out how best they can fit it with the existing laws. Now till here we were talking about taxable event. Now coming to the head of income in which it could be taxed. That also varies across the countries. Like there are only some example that is given in the slide, that some treat. In India we have two things, right? It is either taxed as business income, or it could be depending upon the characteristic, it could be, if it is a gift, it could be income from other sources, it could be capital gain, or say business income if it is held as for investment purpose. But similarly, some countries have clear short rule that it will be straightforward, always taxable under one particular head. And the rates are very high in some countries, like Japan, it is taxed as miscellaneous income. Some country recognize it as properties. Some country taxes it. Some country doesn't have specific laws for crypto assets till date, and they say that ordinary tax rule are sufficient to handle such type of transaction. In that case, one has to just go per the existing law and see how they can fit with the existing law. So the purpose of this slide was to just reflect that there is no uniformity across the globe. That is the biggest problem in this space. And I was also mentioning about the Hedwig case in case of EU, where it was held that virtual currency can be compared with fiat currency in that their sole purpose was to provide means of exchange, and rule that including the exchange of fiat currency for virtual currency and vice versa performed for consideration are exempt from VAT. Though this was the decision of European Court of Justice, yet different countries in EU are also coming up with their own laws in indirect tax also. Like Spain had ruling that for NFT, which I'll discuss later, where they said that NFT is mainly could be treated as electronically supplied services, and per se that is not a medium of exchange. So yeah. Now here we are talking about the different direct tax potential direct tax potential event that could be triggered, and what law of that country provide, whether the law of that country provide clarity around that transaction. So say Australia doesn't have clear shot rules yet for crypto space, crypto segment, separate space, yet there are a lot of ATO's guidance. But still, this slide reflects that, okay, if the transaction is for exchange of crypto asset, then yes, there are possible guidance there, and one could refer to that. So this slide also shows that even if there are, like here, if we see 10, 15 transactions are identified, and we don't have laws, yes, for all the countries. There is no country that says that, okay, I have clear shot rule for all the transaction in crypto life cycle. Should we take some questions, Rishabh, before moving to NFT?
Yes, I was just about to intervene over here.
Yeah.
So no, this is not coming from the participants, it's coming from me. So it could be a personal question also over here. So like in essence, or let's say essentially, the issue regarding the regulations either in direct tax or in indirect tax regarding, let's say, digital assets or virtual digital assets, classifying them broadly, is that we are trying to apply the current taxation or the, let's say, traditional taxation principles to a business model or to a transaction, which is very new, still evolving. Let's say, I could even say evolving every day in terms of technology and in terms of modes of operation. So our issue, like, yes, one you mentioned, unanimity is very clear, because we have not defined the term, we have not, so like then the law goes is a consequence. But more than that, it's that we are trying to apply the traditional principles of taxation either in direct tax or in indirect tax, and trying to classify these assets or let's say tokens into the pre-existing categories that we have. So that's why we are trying to go under either capital gains or business income or other sources, and keeping it very subjective. This is what I understand, and I think that's a bigger problem, because we are still stuck with what we know about taxation.
Yeah, that's point. But even if you think that their characteristic, if we go on classifying, they resonate with some of the current heads. So how can we say that they cannot fall entirely in one head? That's another challenge. So even in some of the previous panel, we discussed that should, for accounting purpose, there should be separate nomenclature. But does having separate nomenclature resolve the issue? Maybe not. Because the way the tokens, there is not a case that there are two forms of token. Okay, I consider that the tokens are evolving every day, and some may resonate with the previous accounting standards. Then how can you say that that will not apply?
That's true. And going about, I mean, this is one of the questions on the panel, is that there are, as you mentioned clearly over here, that there are so many, let's say, events that are happening over a life cycle of crypto, or let's say of a life cycle of a token. And going on that, we can apply a tax or a tax rate only on a taxable event,
Right,
right?
right.
If you can just illustrate a little bit, maybe on a country which you had in another slide, that country is taxing on what taxable events, or maybe just on one of the tokens. That's what the
Yeah,
participants.
or let's take India as an example. See, taxability, we have to analyze taxability in all the case. It just depends that India has said that, okay, if there is an event of transfer, you have to apply 30% rate. Now, how do we say it is a transfer? That you have to see with each cryptocurrency and each crypto asset and see what actually you are doing. And then you have to identify the taxable event yourself in that case.
Right, right. And there's one question more, that as these prices are so volatile, like you click the picture of today's price sheet of the top cryptos.
Yeah.
So the audience is a little concerned on how it can be used as a means of payment when its value is fluctuating so vigorously, that I mean it will eventually get difficult on how much to pay and what to pay.
So that's why the concept of stable coin came into play, no, Rishabh, which are pegged around some fiat currency or some asset or some other sort of thing, which give bit of more certainty. And the reason it is volatile, that's why people are making money by investing. No?
Yeah, if you could just once, because we are talking about stable coins, if you could just elaborate a little bit on the difference between other coins and stable coins, and give a little bit of an insight on about fiat currency and what we are talking as a digital or a virtual currency, because it will help bring perspective to things now.
Yeah, let's discuss stable coin then first. So fiat currency is normal currency issued by the central bank of that country and recognized by that country, and that's how we call it fiat currency. Now, what happens in stable coin? In stable coin, the cryptocurrency is pegged by either fiat currency, or they are pegged with some commodity, or they are pegged with some other cryptocurrency, or they are pegged in such a way that they have some back end algorithm which maintain particular price range based on the market supply and demand, which is non-collateralized algorithmic stablecoin. So this is what people are, this is what has more certainty vis-a-vis the normal cryptocurrency or normal coins. So here, if you see that I have written digital currency that is pegged to less volatile reserve assets such as US gold or US dollar or gold. So they are specifically marked to some non-volatile asset or commodities. Then they help in maintaining price and value stability. They bring more security and transparency because, like the same reason, being less volatile, then they are pegged against some known commodity. Like, of course, US dollar has much recognition. If they are pegged with fiat, people have that confidence that their money will not go anywhere, the money they invest. So that is what stable coin is. Again, in stable coin, there are different types of stable coin. I can take it later when I come to this slide.
Right.
Does
right.
that clarify a bit, Shaf?
Yes, I think it makes more sense to me, and I could connect a little more dots on our previous discussion. I think you can go ahead. There are a couple of questions, but they relate to Indian tax law. So I'm just for the information, we are discussing the Indian tax law in detail, which revolves around the taxation of virtual digital assets. So I'll be taking those questions at that time.
Okay, that's fine.
Yeah.
Now coming to non-fungible tokens. So there was a lot of hype till last year. Still, there are a lot of use cases of NFT, but there was a lot of hype last year hype around NFT, how people are making NFT by just selling around a piece of art paper, and that art paper is something that you get no rights in it, you cannot sell it further. So this slide mainly, first of all, I want to say, describe what is non-fungible, why it is called non-fungible, how the terminology came around. So what is fungible? Fungible means that if I have 1 rupee today, after 10 days also, 1 rupee will always be equal to 1 rupee, right? and that's why it is called one Bitcoin will always be equal to one Bitcoin if that is Bitcoin currency. I'm not talking that one Bitcoin will be equal to one Ether after 10 days. No, not that. Similarly, if I say 1 kg of gold, they will have similar status of one, like I said, 1 rupee will be equal to 1 rupee. That's fiat currency. But what happens in non-fungible? It's not that today two art cannot be similar. That is what I wanted to depict here. That one piece of art, suppose I did one piece of art, I minted that as an NFT. I did some another art of, I drew the same diagram again, but those two may not be same. There could be some variation around it. So that's why it is called non-fungible, that two pieces cannot be same always. And what are NFTs? So NFTs are digital file having unique identity and are verified on the blockchain network. So generally there is a process of minting the NFT, and there are different platforms where NFT could be minted. Like somebody have a piece of art, they can click a picture of it and then they can mint around and make it as a digital asset. So there's an entire procedure around it. And then that piece which you uploaded, that gets a unique number, and that is a unique digital asset. Now coming to, this is one form of transaction. So there are two or more possibilities in NFT. I'm just taking some example. Suppose there is a primary buyer who draws something, like an artist draws something. And artists make a digital asset out of it and puts it in the NFT marketplace. Somebody buys it, but the seller or the artist doesn't give right of further sale to the buyer. In that case, the buyer just have the right in that digital asset. He cannot do further anything with that digital asset. He cannot further sell that digital asset, or he cannot mint again that digital asset and resell it. But there could be a situation where the agreement with the seller could be such that the primary seller, in my example, the artist, gives such right to the buyer that buyer can further mint it and resell it and give some commission to the primary buyer, artist in my example, some rewards for every resale he made. Like more like a license model, which we discussed in transfer pricing, like every sale you do, you have to pay some license fee. Here it's more like reward or commission fee to the primary buyer, primary seller. So that is what this diagram shows. So for NFT, it's very important to see what is the underlying asset, underlying rights and liability the person is getting when the person is buying the digital asset. So there's smart contract along with it, where where one should look for rights the person is getting when buying a particular NFT. So that is what is depicted in this example, this image, because this will be relevant for our tax discussion, this case specifically when the buyer has right to further resale it. So in this case, what is happening that the creator of digital asset here mints the asset and then puts it in the marketplace by paying the listing fee. The primary buyer buys the digital asset, then the primary buyer resell the NFT by minting, and then pay some reward to the creator of digital asset, which you see here.
So Nupur, it's more like a royalty model.
Yeah, I would say more like a royalty model. Be it any name they give it, yeah, you can say that it's more like a royalty model. Because it's more like you are giving right to underlying IP, because IP is that of the artist to further redistribute that art piece. So this slide shows some of the events that have happened in the NFT space. I'm not going through all of this, just added this slide for reference for future. But the purpose of adding this slide was to show that when did NFT market start picking up? So it was mainly during the COVID time again that the market picked up when NFT, when you see 2020, it says NFT market grows by plus 299%, value reached over $250 million. And then 2021 was the year for NFT where some of the prominent transaction in the NFT space happened, where we were hearing that a tweet was worth 2 million of NFT. A tweet was converted to NFT and it was valued to US $2 million. So these all transactions happen, and then more and more companies started finding more use cases of NFT. That was the biggest thing that happened. A lot of companies started moving to metaverse like Nike or other consumer good company, and they started creating NFT out for all of their physical good. And some NFT could also had the right that in future, if you want to exchange this NFT with the physical pair of shoes, you can go and have that. So all such use case started happening, and that's how it started picking. And now what I see is people are finding more use cases. Say in different events also, people create NFT out of it and say that this is a proof that you attended the event. Like earlier we used to have certificate, right? Digital certificate. Now more and more people are using NFT as a proof of attendance. And they say that, okay, if you have this as a proof of attendance, or if you have this NFT, you can have discount in our further courses or next year event. So this sort of use cases are emerging, where it is more coming around as a reward form rather than other actually, if we say cryptocurrency. Now coming to I just wanted to touch a bit on accounting side here so that our tax discussion go smoothly for NFT. So what happens for the purchaser of the NFT, how the purchaser will recognize the NFT in the book. So like we discussed in previous slide, where Rishabh was saying whether it's a royalty model or similar to royalty model, there could be a different sort of arrangement where one could be that you have right to further resale, where in the other model, the person doesn't have right to further resale. All this needs to be factored in while deciding how it should be recorded in the balance sheet for the purchaser. For seller, again, if we say it's a royalty, the model we were discussing, the seller has to record license fee, whatever commission or reward, whatever nomenclature we give it, it's more like a license fee. And then if the creator, if an entity is running NFT, mainly or as a marketplace for NFT, we have to see in what capacity the entity is running. That is that an agent or principal model? Like now, there are different marketplaces. They are per se not the principal owner of the asset or NFT. They are more acting as a marketplace for different people where people can put up NFT. So they are working more like an agent model. They earn commission on NFT sold. So depending upon these, we have to see how such transaction can be classified. Also, one has to account properly for the expenses incurred on minting of the NFT to see that whether for the recording into the book and see whether it could be claimed as the deduction for tax purpose. That is a separate issue, and not all countries allow for such deduction. We'll see that later. Now, what could be the potential issues for NFT? Similar to our discussion, NFT brings also host lot of issues from direct tax perspective. It could be capital gain, withholding tax, gift taxes, capital gain when it is exchanged for higher value and there is some difference in the price, then capital gain needs to be paid. Or say could be a situation where I have a cryptocurrency which I bought for $2,000. Let's take an example. But I exchange it for getting an NFT that is valued in the market now 6,000. Now this difference of 4,000, because I had an asset for which I paid 2,000, but I am getting an asset now for whose value is 6,000. The difference of 4,000 also needs to on this difference of 4,000 also tax needs to be paid under the capital gain head. And then withholding tax issues, India law specifically cover NFT in virtual digital asset definition. So entire provision of section 194 as will be applicable. Similarly, some other countries have also such laws of withholding taxes. And then gift taxes, if NFT is given without consideration, then the question of gift tax comes into play, like we will have in Indian law situation. Indirect tax issue usually arises in cases when NFT is of such nature that it is interlinked to some underlying physical asset. Like I was taking the example of Nike's NFT, where one can exchange physical shoe from a physical store after some time or whenever the person wants. In such cases, VAT goods, GST issues will come, and even if the physical good which has to move from one country to another. Suppose I have NFT for Nike, but I ordered a pair of shoes in India and I asked that shopkeeper to send it to Europe. Then again, there could be custom issues when underlying good needs to move to cross border. Now, what are the relevant points from tax side for the NFTs? First, we have to see what is the nature of the NFT, whether there is any underlying physical good attached to it, or whether there is just a digital asset or a piece of smart contract that the buyer is getting. Now, whether the NFT is for single product or bundle good and service, sometimes NFT could have multiple, it could be linked to services and goods also. Like there could be NFT which could have two possibilities or two benefits, that, okay, if you hold this NFT, you could avail some education services from us in future, and you can buy some books from us also. So these sort of things needs to be analyzed, whether it is for single product or bundle goods and services. Sale of IP or limited right to use the IP, the example which we discussed earlier, the royalty one, it needs to be checked whether it is outright sale of copyright, which give the purchaser the complete right over the exploitation, or it is limited right of exploitation. The example which we were talking about earlier was limited right of exploitation, because there the person had to pay royalty to the primary buyer always here, and the person didn't have complete right of exploitation. Now, coming to the place of supply, this is also a prominent point to figure out, especially when from the indirect tax point of view, that how do we determine the locale, or what KPIs we use for determining the applicable indirect taxes. So whether it is country of customer, country of customer, or the billing address on the invoice, customer IP address, or other contract terms and conditions, we have to check all these conditions. How purchase consideration for NFTs are paid. This I already touched in my example, for where I was saying that I have a cryptocurrency of 2,000, which I exchanged with NFT of 6,000. So this is that situation. There can be a situation in which purchase consideration can be paid in cryptocurrency. In such cases, gain on loss for the buyer on the cryptocurrency used for payment will be liable for capital gain tax. Having all these, it also needs to be said that NFT laws are not that evolved across the globe. So we have to see the local laws of the country and see the tax characterization as per the local laws, because like we have been discussing, the classification issue is a bigger challenge. So here also the same issue persists. This slide is just to give an overview that different countries have different, this is more on indirect tax, because in NFT, yes, there are direct tax, but people see NFT, most of the countries see indirect tax also as a mean for taxing NFT. So this slide shows that how indirect tax regime also varies across the country. And in most of the countries, people are saying that it's more akin to electronically supplied services. And in Spain, there was separate ruling that I said here. The ruling number is given, where they said that transfer of NFT was regarded as supply of services or electronically supplied service, and hence VAT will be liable on such transaction. Because that is fine, because in the Hedwig case for of ECG in the Europe, that ECG, that case focused more on virtual currencies. So NFT per se is not virtual currency. So countries can do whatever they want here in case of NFTs. And also there are some interesting facts that some countries define NFT specifically in the have separate definition for NFT apart from cryptocurrencies definition. in our law, yet it just says NFT will be included. It doesn't have per se separate definition of NFT. All is embedded in 247. But here in New Zealand, they say crypto asset that contain unique distinguishing identification code or metadata. So every country is coming with some unique definition, good definition, what suits them. Now coming to potential tax implication. Yeah. I'll take two cases where NFT seller is the original owner, and second, the case which we discussed, like the royalty, NFT seller is not the original owner. So here, if the NFT seller is the original owner, what could be the tax implication when both seller and purchaser of NFT are in the same country? The sale of NFT may give rise to taxable gain or loss, which we already discussed. The characterization of gain or loss on the nature of asset in which NFT are treated for the taxpayer. VAT rules may apply depending upon the tax laws of the country. So if I go to this illustration, say Mr. A is a purchaser and company XYZ is a seller, are resident both of same country, country C. Now, if company XYZ hold NFT as an asset for investment purpose. Now, it is specifically mentioned that it is held for investment purpose. So I can relate that if I sell it, if XYZ sell it to A, then what could be the possible trigger point for taxable? It could be capital gain or loss. And that's why it is written that company XYZ will have to pay capital gain or loss on sale of NFT. Accordingly, capital gain tax may apply. Separately, VAT laws may be applied depending upon the laws of that country. And the other example is with the exchange of cryptocurrency, which I already explained, but I will rerun. Suppose in the above case, Mr. A pay consideration through cryptocurrency. In the previous one, we presume that the purchaser paid the consideration in fiat currency or normal currency. Here, if the person pays the consideration in cryptocurrency, in this case, if Mr. A acquired cryptocurrency, say at 2000, and now the same cryptocurrency is used to buy NFT worth 6000, which I explained earlier, this could mean that value of cryptocurrency held by Mr. A has increased, and he have to pay separately account for capital gain or loss on the cryptocurrency too and pay taxes depending upon the laws of country C. This was a case where buyer and seller were in the same country, but like we know that in crypto space, it's not that it's so decentralized that it's hardly there could be situation, of course, but most of the situation, the dealings are cross-border, or some people don't even know the identity of the other person. So in this case, if there is a cross-border case, cross-border tax issue may arise and taxability may need to be determined under domestic law plus the applicable tax treaty. Suppose the other problem which can happen here is that same item can be characterized in the domestic laws of two countries differently. Like one country can say it is investment, one country can say it's an intangible asset. That characterization issue again is a very big problem. And if it, in that case, if it is taxed twice in two countries, then claiming foreign tax credit is very difficult. So, of course, our commentary needs to be further updated, and more work needs to be done from the OECD side also in this direction to bring more clarity in the commentary. So here, in the same illustration of Mr. A and company XYZ, if company XYZ is located in country D instead of country C, then reference would need to be placed to the relevant tax treaties additionally to determine the ultimate taxation of gain or loss for company XYZ in addition to the domestic laws. And here also, like it is mentioned, that characterization is the biggest issue. Rishabh, you want to intervene?
Yes, I have a question here on your first example. So there are two situations wherein Mr. A first is purchasing an NFT from fiat currency. So there is only one event, that is disposal of NFT for the seller.
Yeah.
Correct. But when there is an exchange in your example wherein earlier Mr. A acquired the crypto or whatever token for 2000, and now it is paying for an NFT that is worth 6000. So now there are two taxable events which I understand here.
Exactly.
First is the disposal of NFT, and second is the gain on that token from 2 to 6. So here
Right.
both the buyer and the seller would somehow fall under the tax net for whatever transaction they've made as compared to the fiat.
Yeah,
Eh,
and if you think from Indian perspective, in Indian case, the buyer has to withhold the tax here also for the NFT price paid to the seller.
Right,
There will
right,
be TDS applicability under Section 194S also. Yeah.
right. I have a follow-on question over here, more on the practical aspect of purchasing of NFT in fiat, because is it possible? Is it actually happening at a very wide scale? Because NFT is a byproduct, or let's say a consequence again of the blockchain, and then in turn of cryptocurrencies or crypto
Yeah.
tokens. So what I see mostly in the public domain is from exchange of cryptos, whether NFTs are actually being traded in fiat directly as well.
Yeah, there are some platforms that provide such, especially when the use case are such that it is for event or like organizing some event or for some other smaller things. There are platforms which provide such opportunities or such possibilities.
Right. Um, I have again one more question on the rights of NFTs. So because you mentioned that sometimes there are more inherent rights in an NFT, just like beyond the piece of artwork that they are, or beyond that JPG, and those use cases are increasing. If you could quote one example on such rights, one is one you've told of on events. That's pretty clear. So you can sell your tickets, which you were selling probably on some other platform, as an NFT, and you would have proof of attending that event with that picture with you, or with that NFT with you on blockchain. If you could give such like one more example on inherent rights in NFT.
So inherent right, I was talking more in the royalty context, what the secondary buyer or the buyer has inherent right, so that he has further right to resell or not to resell. And now your question is more on the NFT use cases. So one is like education field. So similarly, there could be different universities could also try for NFT. That was just like some specific event planner can use it for NFT, or we could have some gaming event. A lot of gaming NFTs are coming these days. A lot of NFTs of gaming ideals, that if you like a particular idol, you have NFT of this, NFT of particular idol is selling in the NFT marketplace at this price. So yeah, there could be different multiple use cases.
I think Sanjay sir has something to add here.
Yeah. Nupur, I have a special request to you that since you have studied the Indian law as well as the international everywhere, so far as what are the various questions which you would like to seek from the income tax department in India? Can you frame some of those questions? Because I am planning to meet the authorities. And in those questions, if there are any gaps, for example, some leakage can happen if the answers are not given, or some more litigation may come. So I would like that if you can frame those things, then you can send us and you can involve Rishabh also in that, so that I can get some clarification from the uh, CBDT.
Yeah, yeah.
Rest of the things, I think you have raised so many points that I think now we need to take topic wise. In the crypto, I have to divide in various topics, and we
Yeah.
need to deal one topic, then the second topic, and third topic. That the way you have dissected the cryptos, I think it's very good, and you can continue with the rest of your webinar. Thank you.
Yeah, we need to create some series for this, because I will not be
Ye-
covering DeFi DAOs today. So there are a
Yes,
lot of
yes,
things.
yes. Yes, no issue. The thing is this, we hold these webinar 2 times in a month, one on international tax and one on domestic tax. But in any case, we can have your lecture recorded on my DLH, and which can be circulated among the member. Like as I told in the beginning, some of my overseas viewers, or some of my viewers, those who are since a working day, they may be driving, they may be in the office, like you are sparing your time. So they always want me that I should give them the video, because the viewership when we started at 6 o'clock, it was around 751, I think, Rishabh, and now it is around 1,000. So the thing is this: we have a lot of other viewers later on. So this is the topic, because in India, what had happened later part, the same has been covered in PMLA also. So now a lot of people are not at all interested, because they do not want that their life should become some inquiry should come or this. That is why people have stopped investing in the cryptos, and the risk, etc. That is not much you can say worry, but this is something which is worried, because it is now covered in PMLA. So this is something which I wanted to. We can have your, if you can spare. You see, I'm always very reluctant to ask you, because I know that you are very busy. But the way you have explained all these things, it's very good. We may involve you more. Thank you.
Thank
Rishabh,
you.
continue.
Yeah,
Right.
so you have more question, then we should proceed, or we should move to second case.
I think I'll hold my questions for now.
Okay. In this case, we were discussing where NFT seller is the original owner. Now is the case which we have been talking about, the royalty one, Rishabh. NFT seller, distributor is not the original owner, and royalty needs to be paid to the original owner. Apart from the points mentioned above, there would be additional taxes that could be applicable on royalties by the original owner. The original owner may be located in same country or different country. Now, again, if the person is in different country, we need to go to royalty article of the tax treaty also and see how to figure out such payments and how such should be taxed, and whether there is both source or residence jurisdiction taxation or source based taxation, and how the tax treaty royalty clause is drafted there. Depending on the laws of the country and additionally applicable tax treaty, the payer of the royalty may need to withhold taxes on the royalty paid also, like the case in India. The royalty received will also be taxable in the country of the recipient. In double taxation, we may have to see how FTC can work. But again, FTC point, which I mentioned, that if different countries, for FTC, you have to go to taxes covered in the tax treaty. The other country can still say that it is not a taxes covered in my tax treaty and I will not be giving tax credit. The nomenclature is different. This is sort of this is treaty override situation. So all this needs to be figured out in terms of characterization for seeing that whether proper FTC can be availed or how that could be availed. Now, coming to transfer pricing issue for this, before coming to this example, I'll go to two case study. This case study we did last year. So here what was happening, or what is happening, company A is the parent company and company A has subsidiaries in different countries, and some are manufacturing entities, some are back office, some are selling entity. We kept the example very simple. So parent entity decided to release an NFT. The NFT are minted for parent company by company D. So company A has IP of its brand, say Nike. Now it says company D, or say it's a ITS office. Company D is the ITS office, and it outsources the minting part of the NFT to the back office, or say ITS office, and company D mints the NFT. So how would transfer pricing come in? Transfer pricing law could potentially come into play. Company A would need to remunerate company D for minting of NFT on its behalf. What could be the transfer pricing implication? So the minting of NFT could fall in back office function, and company A can remunerate company D based on cost plus model, because in minting usually it's not a very value added function, that I would say, and that's why we can still cover it in ITS services, and it could be recharged at cost plus markup. Should company E and company F pay royalty? So what is happening is that just a second. Yeah, sorry, I moved wrongly to next slide. Yeah. The distribution of NFT, what happens is it is minted by company D, but again, it is distributed by company A in this example. But this distribution of NFT say the Nike NFT is giving incidental benefit to all the subsidiary in terms of brand name, right? So the question arises whether there should be additional recharge for this, like host lot of AMP issues going around India. But there could be argument that this is just an incidental benefit, and there need not be a separate charge for this. And this is something that is done by parent company, and had it been standalone basis, subsidiary wouldn't have done this. In this
So
example,
we are touching a little bit on Dempy also now.
Yeah. Coming to next situation, here what happened is the NFT are minted by company D for company E and F rather than company A. It is done for company B and C. Company B and C in this example are liable for manufacturing a product variant, different segment product variant of the same company. So they have IPs for different product design of the same brand. So mainly they are dealing in different segment and they are responsible for manufacturing in different segment. The NFT are sold by the selling entity, and instead now in this case, because these are the sales entity, these are just the manufacturing entity B and C, so they cannot distribute NFT. So instead, their respective selling entity, when they are dealing with customers, they are further distributing NFTs. And so what could be the potential tax implication? So question could be, could company E and F would need to remunerate company D for minting of NFT on its behalf? What could be the transfer pricing implication? The minting of NFT could fall in back office function, which we already discussed that it is not much of a value added function and it could be classified as ITITS service. And company E and F can remunerate company D based on cost plus markup. Now the next question could be, could company E and F pay royalty to company A for getting the NFT minted for IP of company A? The parent company is holding the IP in this example. So ultimately selling entity is distributing the NFT. So the question is that whether either E or their parent company need to pay some royalty to company A or license fee, which could be a possibility because ultimately they are getting NFT minted for the brand name or the IP which parent company owns. And yes, company E and F should pay royalty for A, and appropriate benchmarking study needs to be undertaken. The sale of NFT by E and F leads to incidental benefit for the entire group. The same argument which we took earlier. There are possible arguments to argue that these incidental benefit, no separate remuneration is required. Now, just to note that in this case, company E and F, which are acting as a distributor entity for the physical product, while for NFT, they can be regarded as doing entrepreneurial function for transfer pricing, because there could be one possibility that NFT is D is doing this function on behalf of B or C, or E and F could directly engage D for minting of the NFT. So the question arises that one, okay, they are doing distributor function, but it is on their behalf now D is minting if they are engaging D. So are they doing entrepreneurship function for the NFT limb? Depending on the laws of the country, there may be further withholding tax on payment made to group entities. Would you have any question, Rishabh, here?
No, I'm just trying to comprehend the case study. It was very interesting. I probably have a question on your previous example wherein you said the NFT holder just before that is not the original owner and the royalty model that we were talking about.
Yeah, this one. I
So
didn't
here,
answer this example of transfer pricing because we already discussed transfer pricing. This is a little bit different from that, so I left this example.
yeah. So over here, when you said the royalties, there should be like withholding tax on royalties also, because that is again a portion of income, and usually the buyer is the one who will either withhold tax in this situation. So what happens is, like, the new buyer is the one who is directly paying royalty to the original owner, or he is just buying it from the seller and it is seller's prerogative to pay it back to the original owner. How is the transaction usually
So
structured?
the exchange platform are designed in such a way that exchange platform gives that functionality. but ultimately the primary buyer is responsible for, because it is in his contract, it is written that for every sale you will give me this much percent, or I will be liable to get this much.
Okay. So it happens pretty much automatically, but if we actually see the transaction flow, then the primary buyer, or let's say the seller of the NFT, has the responsibility to do so.
Because the contract is between them, right? The new buyer may not even know who is the original maker of the NFT.
Correct. So probably the tax liability comes on the seller's part, though the exchange might be doing the function, but if the exchange is, or it's, let's say, peer to peer, then the seller would need to do so.
Yeah,
Right?
I said it wrong a bit. I said the seller would know the maker of the NFT. Of course, that will be the secondary buyer, but he will not know who made the underlying art. May be a possibility, right?
Yeah. Of course. Yeah. Nothing on the case studies. You can proceed. I'll just check if there are any questions on the case studies before from the nothing on the case studies yet.
Yeah. So I'll move to stablecoin, which we touched briefly. Should we discuss it again? I'll leave the types. In terms of tax implication, also there are not much of tax. There could be, but not much in terms of stablecoin. So stablecoin, what could be tax implication? Difference in forex. So if it is pegged with FX, what could be the tax implication? If there is some variation in the FX rate, then this could trigger some tax event. Then somebody is exchanging stablecoin with some goods and services, then it could fall in ordinary tax. It could have ordinary tax implication, like it is treated in normal tax scheme. And there could be NFT. Some could even stake stablecoin and earns interest on stablecoin. The interest gain then will be accounted as normal interest and will fall. If it is cross border, then we go to interest article of the tax treaty. Now coming to metaverse, it's very brief slide. We are not going much into the details, just giving some food for thought, what could be the possible tax issue. So what is metaverse? Metaverse is mainly a replica of physical world, or what could I say? It's more like, so for me, it's more like people used to use a platform for gaming in earlier till now or before earlier. So metaverse is an advanced version of gaming platform which provide much more functionality, and it gives better user experience to the people to do host lot of things in the virtual world. So what could be the potential tax implication in metaverse? One is jurisdictional issue, that is the prominent one for determining the jurisdiction, whether one would trace the locale IP to the place to the domicile place, habitual abode of the person, or it should be locale IP from which the person takes access to the virtual world. So I'll explain this with the example. Now suppose, say a person is a resident of India, but he accesses the metaverse in his trip to, say, US. So in that case, what should be the jurisdiction if he makes certain transaction in the metaverse? Should it be India, the place of the domicile or habitual abode, or whether it should be the place from, or like in my example, US, from where he accessed the metaverse? The next question could be around VAT on virtual transaction. A lot of transaction happened in metaverse, like buying of different sort of luxury product, buying of different sort of consumer goods, event tickets. A lot of events were hosted in metaverse. So VAT was, there were certain decision also, certain things went into court also in this regard. So the question is how VAT could be, how VAT could apply in such transaction. And the next is a lot of discussion happened around a piece of land, Decentraland. Decentraland became one of the known names, especially in virtual real estate, that people were buying places in metaverse to launch company in virtual spaces. A lot of airline companies have also launched spaces, themselves in metaverse. A lot of consultant firms started opening a division in metaverse. So there were a lot of purchase and sale of real estate, virtual real estate to name it, in the metaverse. So how should we tax it? Is it intangible asset? Of course, I think it should be an intangible asset because it cannot be akin to physical land. No. So there are a lot of open question around it, how these should be taxed. Then in metaverse, a lot of data taxation issues or hard to value intangible issues comes into play, because there are a lot of personal data that are exchanged, or a lot of personal data. It entails a lot of issues around personal data. And that's why the point written here is data taxation. And then our favorite topic of digital taxes. Oh, I left one. Okay, no worries. Applicability of digital taxes, equalization levy, SEP, or other unilateral measures could is another topic that could come into place. Suppose the developer of a metaverse is in a particular country in Europe, and now user from India start using that metaverse. Now the question is that India says that please give me equalization levy or SEP for my users who use your metaverse. Determination of value of digital asset in metaverse is biggest challenge because of the volatility again. And there could also be P and FTS issues here if we think about cases where there are jurisdictional issues, or say there could be some incident where server is located in another country for the metaverse, and countries start arguing that no server is here and we make it server P. So such sort of issues can come in metaverse also, and a resident of one country may be paying some sort of suppose if there is a consultancy firm in metaverse, somebody needs technical advice and go to that firm and take the consultancy in a virtual world, then there could be a FTS issue also. So endless point to think about.
I think, Nupur, I'll come to you for my own consultancy on purchase of Ether towers. So when as you correctly showed in the timeline that 2020 and 2021 was the booming period when people were home during COVID and had nothing pretty much to do. So that was the time people were venturing and being creative about that. And I also purchased something called Ether towers. And
Wow.
yeah,
Okay.
so I also own a virtual space. So I would have to come to you to understand a little bit more on that.
So what are you doing out of that asset?
Nothing. You could just call it peer pressure.
Okay. Understood. But see, it's not. I attended a conference last month. Yeah, it was last month. People were talking about that metaverse is not completely dead. So I think it's just open question, though we don't see that much hike as it was last year in the metaverse, but still people are saying, no, it's not dead. But for me, the metaverse is most useful case for online gaming, for giving more better experiences for the online gaming platform, because one of my friend is into gaming and he developed metaverse himself, and he's selling his metaverse to different people around to host some events around, say, singing events or some other sort of event. So in those sort of event, it find use cases. But all other sort of hype where there was even litigation on some of the prominent cases where some artists copied Birkin bags of a famous luxury brand, and then host lot of case went around in him. Then he started arguing, no, I drew it in similar pattern, but that was my vision of imaginary world. It's not that I wanted to copy that brand. So yeah, there are a lot of trademark and IP right issues in this space, especially the metaverse.
Right.
Any question before we go to?
Yeah, I just want to add that if you do not know how to swim, so the best way is to push you in the water so that you can learn the swimming also. So the way I think Rishabh is doing this, that in order to learn something, he's putting the things over there so that you can understand the nuances of everything. It is good that because unless until you know how the transaction take place, how the flow is there, how the money comes, how the other things is there, then how the right is created, then which are the, as I said, the citus is very important, and which are the laws which are going to have the effect, because this is going to be a big opportunity for the various people. The way the transactions are taking place, the way the things are going on, it is going to be a mind-boggling. I think it's a it's a new criteria. People will come and ask about that. Have you have any experience in the cryptos? We want to have discussion how to have this. So I think you have covered it very well. Please continue.
Thank you. So the entire what you said, I agree. The fundamental of decentralized network or the entire way blockchain has come around. People have realized that blockchain crypto may be some country may be accepting it, some country may not be very positive about it. But if you see the entire decentralized network or the blockchain space, no country is against it. Even India passed CBDC law last year. That means it's not against cryptocurrency. They are just thinking that if it is not in government control, how things may pan up. So yes, we will see a lot of decentralized finance or other cases in the coming time. Now coming to other global development, this is more on reporting side. Just wanted to touch bit on CAF, crypto asset reporting framework. This was reporting guidelines issued by OECD, where they laid down how these segment can be made more transparent. So here it was, they even proposed some amendment to CRS, the Common Reporting Standard, to cover variety of digital asset. CAF does include a comprehensive framework and guideline which aim at increasing transparency in the segment. So until now, the entire world was saying that there is identity mismatch. People don't know whom they are trading with. So identity or KYC was the biggest thing that was missing in the space. And this is what CAF and this transparency tool are trying to do. It mandates digital asset intermediaries such as crypto asset exchanges, wallet providers, referred to as crypto asset service provider in the law, to do due diligence to identify their customer and to report customer aggregate exchange and transfer annually data to the local tax authorities. And they even can disseminate this information under automatic exchange of information to different countries. Yet there are still not comprehensive guidelines. These are just like CAF was issued by OECD, and now different countries have to impose in their domestic law to see how they want to implement it. Then EU was front runner in this. EU brought around DAC 8, which is not 100% replica of CAP, but in essence, it tries to do the same thing, bring transparency across the sector. And it also put a lot of obligation on digital market intermediaries in terms of different KYC procedure, due diligences procedure to bring more of transparency in the segment. Also, in EU, there are a host law of other law that is going on. Data Act, MiCA is another big law that is just trying to regulate digital asset segment. But there could be question that is MiCA good, is MiCA not good? So people have different MiCA and DAC 8 both. So there are mixed sentiments, I think, in the community. Some say it's better to have regulated segment so that people are less afraid of dealing with it. Things are regulated. Anyways, we were not doing some wrong things. So why should we worried of the law? But it does raises a lot of documentation, lot of paperwork, lot of procedural by paperwork, I mean compliances, and lot of data feeding work in terms of providing different data across the segment. And some countries have been issuing their own local reporting rules on smaller scale. But still, I think CAF will, over time, more and more countries will start adopting CAF, as EU has already done as a front runner. So more and more countries, especially the OECD countries, will start doing it. Now coming to India. Before coming to India, do you have any questions, Tasha?
There was one question about, is actually OECD working anything on crypto assets? That you squarely covered over here. So that's not a real question. More than a question, there was a comment on Web3 and DeFi, though we are not discussing it. But I'll just read out the comment if you would like to respond to it, is that the whole point of Web3 and DeFi was to go borderless. So the problem here is that we are trying to get into the borders, which is creating issue on at least for Web3 and DeFi.
but it cannot be ever borderless. Otherwise, country cannot give up sovereign right. We have to be practical. It cannot be that it will be entire borderless. The entire purpose of DeFi was to remove the middleman, like the banking sector, where people have to pay a lot of interest or other segment or other things. So that was more the DeFi purpose, which I see, to encourage peer-to-peer lending, and people can help each other in a more better way.
Right.
But borderless decentralized network was more to, the entire Web3 is more to reduce the involvement of the central authority. This is what I see. It's not that people were saying borderless, non-borderless. It was overall, it was seen as the less regulatory side. But yes, I think, if we live in a practical world, no country can do that, because they also have to take care of their economy, and they cannot leave everything like this and say, okay, you are, then people, banking segment will start falling down. Already some countries are in recession. Again, there will be more of downfall. So I don't think that's practically possible.
Right. I think no more questions on this front because there are a couple of questions on taxation. So I would like to take them up once we are done with the Indian regulations.
Yeah. So coming to Indian regulation, so I think most of the people would be knowing about Indian regulation. How depth I should go into this broadly or more into depth? I'll just run through slide and see how we are covering, and then you can stop me if you think it's going too basic or too deep.
I think you should cover it squarely because a lot of people are here to actually judge on their transactions. Like I told you, I'll consult with you for the Ether towers. But yes, I think Indian regulations are very relevant at this point for people who are actually working, trading, investing, or whatever, like somehow involved in this space. So, I mean, it's up to you. I would say like you should cover it squarely.
Yeah. So this chart shows what happened in the Indian space over a period of time. So it all started in 2017, where RBI released a press release, and then a committee was constituted with some ministry and RBI for looking into the matter. Then again, there was some discussion and press release. So I'm coming to main crux point. So RBI issued, the major event that happened is RBI issued a circular where it aimed to deter people who were transacting, especially the intermediaries and users who were dealing in virtual currencies. This happened in April 2018. And then the group of people challenged that, this group of people who were in this segment and others challenged this decision in the Supreme Court. And then Supreme Court later quashed the decision and saying that it's not illegal per se. It's still not clear that whether it is illegal in India, but still that decision was quashed. But still people raise question in India whether it is legal or illegal. But later on, rather than clarifying much on this side, or should we automatically presume that since the RBI circular was quashed, it is legal? Opinion vary on this point. But later in 2022, last year, we had new tax laws for virtual digital asset, and we will discuss that in later slides. So what does our Indian law says around virtual digital asset taxation? First, let's see this diagram, that's better. So it says that virtual digital assets shall be taxed at the flat rate of 30% under section 115BH if there is a case of transfer. So we have to focus on word transfer. So only in cases where we can say that it is a transfer of VDA, then only section 115BH will be applicable. Suppose I stake my cryptocurrency and earn interest out of it. That is not a transfer. So in that case, section 115BH will not be applicable. So, and then they define the meaning of virtual digital asset in section 247A. And the definition is very broad. It covers non-fungible tokens, cryptocurrencies, Bitcoins, and other coins. And also, there is a specific clause which says that central government is granted the power to specify any other digital currencies in the definition of VDA by notification in the official gazette. Means that later on they can give more, they can add more points here or more to the definition part of VDA. Then section 115, section 115 BBH, which I said, that says tax on transfer of VDA, the tax shall be 30%, but there will be applicable surcharge and cess. That it says flat rate, but that doesn't mean that cess and flat surcharges will not be applicable. But some other country tax gain on sale of VDA as capital gain at prescribed range and not the flat rate. So there was a lot of questions or a lot of people raising the sentiment that 30% rate is so high. So it's implied that Indian government want to deter people from using crypto assets or cryptocurrencies. Yes, I don't know what should be the answer directly to it, but yes, different countries have lower rates. Some have slab rate system. So practices here are not very straightforward that all countries are levying straightforward rates. Some are just following tax slab rate like they follow on the ordinary rule. Some have lower taxation rate. So we'll see what happens in coming time, whether they decrease it with the whole host of technology discussion going in India and the way India is coming up. Maybe we see lesser rate here in coming time and more stringent reporting requirement. That could be one way. Let's see what happens. And on addition, they said that no deduction will be allowed except cost of acquisition. And no carry forward of losses will be allowed also. No carry forward, no set off for any sort of income for VDA. So one has to just pay 30% flat rate. That is what is written here. Allowance of deduction and carry forward of loss. No deduction is allowed for any expenditure other than cost of acquisition. And also it is clarified that cost of acquisition does not include infrastructure cost or somebody incurring some cost. In many countries, infrastructure costs such as equipment, electricity are deductible. So this was not very much clarified in Indian laws yet. Further set off of losses arising from VDA is not permissible in India, but some countries, I just picked up one example here, some countries allow for some range of deduction that you can deduct up to this much percentage. Like there's an example written for Sweden, which allows a deduction up to 70%. And also, since the section start with non-obstante clause, my understanding would be that even the basic threshold limit, so say somebody just have income of say 2 lakh below the threshold limit of Income Tax Act, that person also need to pay here the taxes at the rate of 30%, and the basic exemption limit may not apply because the section start with non-obstante clause. And the other thing they clarified is regarding the gift. Gift is covered under income from other sources. I'll discuss that in detail, and that will not be covered in 115 BBH. Gift is where the virtual digital asset is given without consideration or for some other, mainly without consideration, or somebody receives mining reward, whether mining reward can be gift, maybe not, but whether somebody receives something else as a reward from the community, whether that can be regarded as gift. So these are some questions. These are some, so in total after this law, there were 4 things that came around: 2 notification and 2 circular. The 2 circular are more from the TDS applicability side, and this 2 notification 74 and 75 was more from the more to give more clarity to the definition, more around. In the first one, they said that mileage point, reward point, or royalty point may not be covered. Subscription to website or platform may not be covered in virtual digital asset. Like here, we can relate the example which we said for NFTs. No, education one, you attend an event, you get a proof of attendance. That might not be digital asset in our law because it says a reward point, loyalty card. This may not be regarded as NFTs. This may not be regarded as virtual digital assets. So if somebody mints NFT for that purpose, that may not be covered in Indian tax law in section 115 BBH. And in the other, they clarified more like when the NFT has some underlying tangible asset and tangible asset ownership of such underlying tangible and transfer of ownership of such underlying tangible asset is legally enforceable. So we have talked about the case where the NFT had some underlying physical asset. So we may rethink that case, depending upon the case, of course, knowing more detail, whether we can get exemption from the definition of 115 BVH for those transfers. This is just an extract from income tax return form, what people have to fill around date of acquisition. It looks simple, but when it goes to fill, when one has to fill, it's not that simple. A lot of detail needs to be figured out. So date of transfer, head of income under which it is to be taxed, whether it is capital gain. It could be, see, 115H is a general law, but whether it's a business income, capital gain income, it just depends upon the purpose or underlying motive for which the asset is held. So if somebody is a trader in India and is transferring and dealing in virtual digital asset, he may be covered. For him, it may be business income vis-a-vis the capital gain income. Cost of acquisition, consideration received, income from transfer, and then you calculate the income. And the biggest challenge, practically what people were facing, and now that different common platforms have tried to resolve this, is that people were having different wallets. Say one person can have 100 wallets. And now how to get data of all data from all the wallets and then figure out these transactions. And can there be some common platform which picks up all the wallet and give them single report like we have for mutual fund in India? But I think there are some platforms now in India that provide such services. But yes, what I hear from people that maybe data is not 100% correct, what we gather, but still it is survivable and people are using that because sometimes it's not possible to do 3,000-4,000 transactions manually. So people have to rely on those data. And then coming to tax deduction at source, also in the law, it was prescribed that TDS will be deducted at the rate of 1% when payment for virtual digital assets are made, and they specified some smaller threshold, which is so small to even think about. So no point reading. And then they came around with 2 more circulars providing more clarity around who is the person liable to withhold the tax. So some cases there could be multiple parties involved. So there could be buyer, exchange platform, seller. So if buyer is paying for virtual digital currency to exchange platform and exchange platform in turn is paying to seller, should buyer withhold the taxes? So these all sort of questions they clarified. They clarified in that case, exchange platform may be liable to deduct to do the withholding tax obligation instead of buyer. So in case of where some questions they clarified around when consideration is not in cash, is in kind. So in that case, how do one ensure that appropriate tax are deducted and paid to the government authority? So in that case, they said that such consideration is in kind could be released by the buyer only when seller proves that he has the tax is paid to the tax authority and he gives some proof to that, then buyer can release the payment in consideration. And then there were questions around peer-to-peer exchange, like I may be exchanging, I have a cryptocurrency and say Rishabh has different cryptocurrency and we may be exchanging. So we both may be liable to deduct taxes because there are 2 taxable events, both from my side and his side. So these sort of questions they clarified more. And in case of certain SSCs, especially the point 1 referred above, in the liability for deduction, they clarified that even taking PAN number may not be mandatory. The person can use PAN number and do 26QE, if I am not wrong. There is a separate form for this. 26Q is for normal and 26QE is for people who doesn't have PAN number, and they can use PAN and quote and do the TDS statement. Now coming to some prominent questions that arise around the Indian tax law. So we all know that chargeability in tax laws is governed by our basic section 4, 5, 9, and per which resident is taxed on worldwide taxes and non-residents are taxed on source-based taxation. The question mainly arises in case of non-resident taxation. So how do you determine the situs? So situs of, because in this space, like we have been discussing, everything is so decentralized and it may not be possible to determine the situs in a completely like it could be completely location agnostic, and it might not be possible sometime to determine the status of the transaction. So in this case, how do you determine that? How do you levy tax on non-resident? How can we say that income has accrued or arisen in India? Because then only we can have taxability in the Income Tax Act if I go to section 911. Now, the other question was around what sort of transaction could be regarded as transfer. Transfer is defined in a very inclusive manner in Income Tax Act, but still there are transactions which clearly doesn't fall in transfer definition. Like if there is some cryptocurrency or certain thing that is lost, stolen. Suppose somebody forgets his private key, then he has to forget that he hold. There is no other way there. He just have to think that he has lost the cryptocurrency to get his private key back. Then lending of virtual digital assets for earning stake. This sort of transaction happen a lot on DeFi network, where you can put your cryptocurrency as a collateral. You can put your cryptocurrency to gain some interest. So these sort of transaction, there is no actual transfer. You are just taking it for gaining some interest. So there might not be any transfer, and such transaction may not be covered in 115 BBH, but yes, the interest income you earn or other things you earn, that will be covered under normal interest provision or other relevant provision under the tax law. Just written some tax laws where it is said that in United Kingdom, theft of crypto asset or loss of private key is not regarded as disposal. In Australia, they accept both as disposal event. So yeah, every country have different laws here again. Coming to mining transaction, some country, this we already discussed earlier, where we said that in India, the mining for mining rewards or mining transaction, whatever is earned, the mining token, the taxation of same is deferred till the disposal of the token. But some country says that whenever the miner gets the reward, you have to see the market value of that, and per that you have to record it in your books and pay taxes on this. In US, it is included in the gross income at the date of receipt. In Norway, taxable income is based on market value of cryptocurrency received at the time of extraction. And again, the biggest question come around when you compute the mining gain or loss from the mining reward. Can you deduct the heavy cost that miners incur, especially when they use proof of work as a consensus mechanism? Because in that case, they have to buy powerful computers and other infrastructure for solving the complex mathematical problem. So some country allows that as a deductible item, some country doesn't allow it. Then foreign transaction forging transaction, the taxability. Forging transaction generally happens when people use proof of consensus as a consensus mechanism rather than proof of work. So proof of stake, the one which I discussed in the first slide itself, where people put their stake in the crypto. Suppose there is a Bitcoin, there is a space where I own 30% stake. It's not possible in any of the network in crypto asset to own 30% such high volume by any individual person. But if somebody puts a lot of his stake to say that, okay, the next transaction will be I get more chances of validating the next transaction. So in that case, the transaction, it is called forging transaction. So one is mining transaction. This happens in case of proof of work. Forging usually happen in case of proof of stake. So in this case also, per the Indian laws, there should not be a transfer because they are not treating mining per se as transfer. So my understanding would be this could also not be transferred, and they can defer taxability here too also. And then there could be question around when employer gives employee virtual asset, either as perquisite, could be gift, or even some employers give salary to employee in cryptocurrencies, but not many. I have not heard about that situation in India, but yes, outside Europe, I have heard about that situation. So in that case, salaries, that will be normal taxable. I think in salary case, it will be we are the normal mechanism, because it says, our law says the date it accrue, the wording is such that you have to accrue based on the market value, you have to withhold the taxes based on whatever, even if you give cryptocurrency, you have to consider the market value of fiat and withhold the taxes. I mean, the employer has to do it. The same question arises regarding what should be the perquisite value, whether it could be regarded as gift. And if gift, how should it be valued? Because there is not much clarity against how it should be valued in India. Yet people are taking some fallback mechanism here and there, which I'll discuss later. This table just gives some brief snapshot. So in exchange of fiat currency, so if somebody transferred cryptocurrency in exchange of fiat currency, suppose I have a cryptocurrency and I give it to Rishabh pays me fiat. In that case, it is transfer of cryptocurrency. I transferred him my cryptocurrency, and then in that case, it will be taxed. It will be covered under Section 115 BBH, and 30% tax rate will be applicable, along with applicable surcharge and theft. In exchange of good, again, it is a case of transfer of cryptocurrency, because it's more like a barter transaction. I am exchanging something or transferring my ownership in the crypto asset. In that case, also it will be covered in Section 115 BBH. In exchange of another cryptocurrency, which we already discussed earlier, this will also be covered in 115 BBH. Now the question is transfer without consideration. In that case, Indian law says that it will, if it is a gift, it will be covered in income from other sources, and in the applicable section will be the normal gift taxation section 56 to 10. Mining reward, like we already discussed, it is deferred till the disposal event. There are also a lot of airdrops or hard forks or soft forks, a lot of these sort of terminology in the crypto space. So now question also arises whether hard airdrops, for airdrop people might not have done much. So should this be regarded as gift, or should this be regarded as business income? So here again, you have to see the entire purpose why the person is holding the main asset for which he got the airdrop, why he's held, what is the purpose of the cryptocurrency he's holding in the network, and then decide. Not much clarity as such is provided in the law. Clearly, something is specified. Coming to the issues, I don't have much slide left, so just 3 slides. So coming to the issue, cost of acquisition. So when what the law says, 105 BBH says that you can deduct cost of acquisition. Now, some people raise this question that whether cost of acquisition would mean index cost of acquisition in long-term capital gains. So yeah, it should be long-term index cost of acquisition should also be allowed, because even though the section start with non-obstante clause or other things, because if we read section 48, which helps in determining the capital gain, it says that cost of acquisition in para 1, if I'm not wrong, should be replaced by index cost of acquisition if we go to third proviso of to section 48. So if we think in this manner, then yes, index cost of acquisition can also be allowed as a deduction. When asset is held as stock in trade, deduction cannot be availed for all the deduction that are listed from section 30 to 44D cannot be availed except cost of acquisition. This is very clear. Now, the other big question came around intangible assets. So there is a bit of consensus among IFRS community, I would say, that crypto in general can be regarded as intangible asset. So the point that was raised that if it is intangible asset, should the cost of acquisition in income tax law suo motu be nil? Because there was an amendment in the Finance Bill 2023 where they have added in section 5 intangible asset also. So, and there have been some case BC Srinivasa Sethi, where a lot of discussion around these issues have happened. What do you take as cost of acquisition? So people have raised this question that whether the cost of acquisition in such cases should be nil. And there is not much clarity yet in the law around this. In case of withholding tax, where the payment is made to residents, non-resident, we generally apply section 195, that is accepted principle. But for virtual digital asset, there is a separate section 194S. Now the question is, which one will apply? So in case of non-resident, 195 should apply because that is more beneficial and that is more specific. But there can be questions around issues like when the foreign company has a POEM in India, and there could be a situation where item of income may fall both in 195 and 194S. Then which one should prevail in case of non-resident? Logically, 195 should prevail in case of non-resident, but yes, it would be good to see more clarity in some circular around these directions. Then exclusion of foreign currency. So our definition very well says that it excludes foreign currency from its scope. What happens in situation where cryptocurrency is recognized as legal tender in some countries? 3 examples which we took earlier: Panama, Central African country, and EI Salvador. So then we have to go to definition of FEMA. In FEMA, foreign currency is defined as currency other than Indian currency, right? And if we see what is how currency is defined under the Indian foreign exchange laws as to include all cryptocurrency note, all currency note, postal note, money orders, checks, draft, letters of credit, bill of exchange, promissory note, credit, or similar instrument. Now, can we say it is a similar instrument, or do this need separate notification from government if such situation arises that a person is dealing with some people in those countries where these are recognized as legal tender? Yet there's no specific clarity, and it is left to our understanding whether we treat it as similar instrument or we say no, foreign currency should exclusively, like such sort of items should be excluded from the definition of currency, and it will not fall in currency. Now coming to valuation issue. So valuation of cryptocurrency for determining valuation is essential for determining cost basis, especially in case of gift or other item, because if the seller or let's say somebody is giving gift, how to determine the cost basis in the hand of the recipient, because the law says that it will be taxable in the hand of the recipient where it exceeds the threshold, which we read earlier. So the normal gift taxation exemption threshold applies there, which is 50,000, and when you receive from relatives on specific occasions, it will not be taxable. So how do you determine the cost basis? Different, if we think from different country perspective, and also how do you determine what method you follow for seeing which crypto asset you are transferring or which crypto asset you are donating or gifting. Say if I have 15 cryptocurrency of similar nature, 15 Bitcoin, and this 15 Bitcoin I purchased on 15 different dates. Now, if I give 1 Bitcoin to somebody else as a gift, which like the value will be different for different 15 Bitcoin because the acquisition date were different. So which cryptocurrency you will think that is given now as the gift? Different countries follow here different approaches. Some follow FIFO approach, some follow deemed chronological order, which is similar to FIFO. Specific identification of unit in US, Denmark, Norway, weighted average cost, basis pooling. I think in Indian law, it is not that clear yet. And even on taxation, on valuation thing, we have a fallback mechanism of section 222B, where it is said that you have to take the fair market value, because not much clarity has been provided around valuation yet. And some countries specifically have made it clear that taxpayer may use information available in the market to determine taxable value. Like in case of Lithuania, taxpayer may determine the taxable value by using conversion rate provided by a reputable exchange with reasonable trading volume. Such sort of clarification is not there in Indian law. And it's like we have a fallback mechanism of 222B, which says fair market value. Now coming to some international tax issues, these are just broad issues, just point for food for thought point. So these all we now discussed about the domestic law from Indian perspective. Now, there could be multiple international tax issues. Some we pondered in the NFT discussion, but those can also happen in case of other crypto assets. One is permanent establishment article. This there could be different reasons for it, like fixed place permanent establishment server SP article could somebody could raise that contention, and then we have to see that whether the server had sufficient link between the income, whether the person has sufficient link between the server and the income. Then once permanent establishment article is invoked, we have to see that whether there needs to be some allocation in permanent establishment article. Then reward for mining forging could be regarded as business income, because the person miner or the person who is doing proof of stake consensus mechanism, it may be regarded that these are sort of their business income, and Article 7 may come into play when there is a cross-border situation. Royalty article, we already discussed one use case in case of NFT. Royalty could arise, a royalty question can arise in different cases also. There could be FTS also, which fees for technical service article also, which we discussed, that somebody taking advice in metaverse from a consultancy firm, whether fees for technical service article could apply. Then for sale and trading activities, domestic law says for capital gain tax. So if it's cross-border, then we have to see the implication under capital gain tax article in the tax treaty. And if something doesn't fall in any of this category, and if it is a cross-border situation, it is deemed that it is other income. We have to test it in other income articles. Now, the question which I had mentioned earlier also, the major difficulty is on characterization. If two countries characterize the same item differently, how do you apply international tax properly on it? Whether it is possible to completely avoid double taxation in that situation. So these are some open questions to ponder upon. And I think the law is not straightforward that we have 100% clear laws yet. It will take some time for more use case to come, and then policymakers to come along with more regulation. We are still on pillar 2, so we hope that after some time with digital tax, we have some time for the sort of new technology solution for AI and crypto space. Now, at least if globally nothing could be harmonized, what could be done at least by domestic policymakers is that at least they can give clear guidance from time to time, give simplified regulations or simplified compliance mechanism, and time to time review of policies in light of different tokens coming in. Like I said, that in India also there could be various points where we may need more further clarification. So we may raise this question and we may get more clarification. There could be simplified mechanism, like some tool or some sort of help from government in terms of simplifying the law, rather than somebody sitting on last day filling 4,000 line items, or some sort of simplified solution, or some sort of cooperative attitude. That's all from my side.
Right. Thank you, Nupur. Though we have just concluded in time, but as a policy, we would still hold you back for another 5-7 minutes just to take up all the questions, because we would like to clear the board on questions before we go. And as you clearly mentioned on open issues, so I think definitely a lot of people would be coming back to you with their queries. But as of now, I'll ask on, and I'll just mention what all you have also answered, which were there. So airdrop of tokens, you've like squarely covered. About indexation benefit, I think it's one of the open issues that's there. Also on the loss set off or previous year losses, also you have covered. So these were the parts which were there in the Q&A. So just acknowledging them, and I think you squarely covered it during our discussion. A couple of things, like specific things, was on people getting their salaries in crypto, though not very prominently used method. But they get their salaries in crypto, could be a stable coin or could be another other coins, and eventually they convert them into fiat for, obviously, for personal expenses. So they just want to know your view on the pitfalls or steps they can take so that they are like at least near compliant from income tax perspective.
Yeah. that needs a bit of pondering from my side also. But I would say squarely in that case, if we can prove that employer has did the proper market valuation and withheld taxes, and we are able to prove there is no way we are trying to get out of taxation. And if I'm converting fiat currency later, it's that I have already paid taxes on it, then I think there is a possible argument that if tax is not avoided, then why tax authority will run.
Right.
And
So I
maybe
think
it could be other possible thing could be that crypto currency is converted in fiat and later date the person may have some gain out of that, and that person may have to pay taxes because our tax authority is not going to leave.
yeah, and also report that. So basically, I think you will have to be vigilant both on the part of the employer and then on when you are actually converting it to fiat.
Yeah.
Second question I think is on legality, uh, saying that if we see that our tax authorities have made laws, so do you think it automatically brings holding and doing business of crypto outside the scope of an illegal activity?
Yeah, there are a lot of discussion and discussion in different platform around this. I think there is no straightforward way to say that it is legal. By bringing in tax law, it doesn't mean straightforward it is legal. This would be my thought around this topic until they give more clarification around it. But yes, I see that a lot of blockchain companies or a lot of DeFi companies, a lot of people doing NFT startups in India also, and government is not running too straightforward around them, but still they have not clearly mentioned that it is legal, and bringing tax doesn't itself justify that it is legal.
Right. I'll just add one more thing over here. That was on RBI circular. So when we are talking about legality, we are not just considering it as a legal tender to be legal. So you can hold crypto tokens or coins, but it might not be a legal tender. So there is a very big difference between a token or a cryptocurrency being a legal tender and a cryptocurrency being a legal asset, or let's say a legal commodity to hold or transact. So if you're talking about legal tender, it's pretty much clear that it's not a legal tender. And we've seen the countries we have clearly seen which are putting it as a legal tender. So in India, definitely not a legal tender. But on the legality of holding it and transacting in it, yes, it's a gray area, but nothing on specific. And I completely support your view on that. Just including it in tax law really doesn't mean that it's a legal business. Right. So second, I mean, it's just again a passing on comment or a follow-up question on this, that why, if it's not illegal, or let's say it's not a sin, then why it is being looked upon as a taboo in our country? And the moment people are said to own some cryptocurrencies, they rush to deny or disown the same.
Sanjay sir will answer this.
Yeah. Let me tell you, actually, the basic government thinking I'm supposed to look into, they think that it is like a lottery, and people will burn their hands because it is so much lucrative, and what we have seen in the past, people have indulged into money laundering. That is why government want that people should desist from in crypto, instead of making it as a scientific way of creating the wealth or scientific way of dealing in the money. So the people have started thinking that in the government exchange that it is a basically lottery where you have to lose the money. So that is why I think this is one of the intention. But the way Nupur you have explained various facet of the crypto asset, what could be the crypto asset? It is not just that is something which is speculation only, that you invest, like if you invest in drugs, then you may earn a lot of big money, or you may go to jail. So this is something what we are trying to explain, that look, crypto is to be treated as a scientific way of creating the wealth. So very good, you have explained. I think Rishabh, all questions you have cleared, because I was in between. Everything is cleared.
One more question is left, which I would like to take up.
Okay, do it.
And
Then
then
I'll try to give the vote of thanks.
yes, just last question. And passing on comment again on this taboo thing, my view is that, sir, I don't think it's a taboo of holding crypto. I think I have openly admitted on investing in Ether Towers. That was an
Yeah.
NFT in Metaverse. So I don't think that's the case. But yes, what Sanjay sir mentioned is squarely correct from the government or the revenue side. And everyone is a little apprehensive for things they do not have complete knowledge about. So
Yeah, and
that's just human nature.
I have also heard situation where initially investors were also a bit stringent in investing in Indian blockchain project, but the way the events are happening in Indian market also in the blockchain space, there are multiple conferences, multiple event happening for blockchain startups. So I think the attitude, if it is the attitude that will change, that may evolve in coming time, and considering that India is one of the most developing nations, investor sentiments are also changing and in that space too in Indian market.
Yeah, I think that would conclude on the question board. I think, yes, there's just one small question on, can a person run like a cash pool, like a mutual fund, collecting funds from people and have a invest in crypto and have crypto business. So I don't know if it's like there's a clear answer to it or not. So if you, on your comments.
That's more like then we go more into DeFi side, no? That how to maintain cash pool and how people can take. Maybe I can handle this question of chain also, because I haven't covered DeFi, and then I go on discussing now DeFi. Some people may be lost.
Yeah, so the question can be cleared in person with Nupur.
Yeah.
And this concludes our session with all the questions on board. Sanjay sir, for your vote of thanks and
But
common conclusion.
I would like to comment on this. The SEBI punishes such type of the you can say doing the treatment, that you take the money of the people and then you invest somewhere and then you pay them interest. SEBI is treating it as a unregistered activity. So be careful. Do not indulge into any of such activity.
License
Friends,
may be required.
yeah.
So sorry. Just
Yeah,
adding,
Sarji,
some
please.
country are providing license for it also. So depending that whenever India prescribes specific license for that, somebody can do it. Some country already have some licenses for that where they can take that license.
Yes. So, viewers, I think we have 2 hours of mind-boggling discussion. Your questions are completely answered, as I have been told that the board is clear. I always say, and it's very common then when I say that when my speaker clears the question, it is just like a cashier gets cash tallied at the end of the day book is tallied, it is perfectly matched. So cash balance and physical balance, book balance, everything is tallied. So Nupur, you have done excellent job, and I think a lot of people will be after you. Be careful that now you will get a lot of calls, etc. And let me tell you one more thing, which is very important. That this session, those who have not seen it, I am telling the viewers, those who are with us till the end, that if you do not want to sleep in the night, do see my video of Nupur Jalan on cryptocurrencies, because I think after listening to it, you will not be able to sleep it. You have a lot of questions in your mind. So with this, thank you very much, viewers. Thank you very much, Nupur. Thank you very much, Rishabh. Thank you very much, DTC staff, for organizing this. Thank you, Vice Chairman, who's in Mumbai, taking the position there, because I am not there because of some personal engagement. Thanks, viewer. Control room, kindly conclude the proceedings.
Thanks all.
Thank you. Bye-bye.
Bye.
Control room, please conclude the proceedings.